If you're setting aside money for retirement, individual retirement accounts, or IRAs, can provide major tax-related benefits. This video helps you understand how to choose between the two most popular IRA types, traditional and Roth. They both provide tax advantages, but in different ways. When you invest through a regular taxable account, you're required to pay taxes every year on most of your investment income, and on any gains when you sell assets. This can slow down how fast your investments grow. A big benefit of both traditional and Roth IRAs is that your investment earnings, and any gains from selling or trading, aren't taxed while the money stays in the account. This tax deferral can help your investments grow more efficiently. Where traditional and Roth IRAs differ is in when you receive the tax benefits. In short, you're choosing between receiving a tax deduction now or having tax-free withdrawals later. Let's break it down. If you go with a traditional IRA, your contributions might qualify as tax-deductible. That means you could reduce your taxable income in the year you contribute. However, that doesn't mean you escape taxes entirely. You'll still pay taxes, just later. Specifically, when you withdraw money from a traditional IRA, it's considered taxable income. So, a traditional IRA gives you a tax break now, while deferring taxes until retirement. Now let's consider Roth IRAs. With a Roth, contributions aren't tax-deductible. That means you don't get any immediate tax savings. But here's the advantage. Once you've contributed to a Roth IRA, you'll be able to withdraw money in retirement completely tax-free, as long as two conditions are met: you've had the account for at least 5 years and you're at least 59.5 years old. So essentially, Roth accounts offer a tax break in the future. Which one is better? It really depends on your situation. One of the biggest deciding factors is whether you believe your tax rate in retirement will be higher or lower than your current tax rate. If you expect your taxes to go down in retirement, a traditional IRA may be the better option. For instance, your mortgage might be fully paid, or your dependents may be grown and no longer financially dependent on you. You may not need as much income, which could place you in a lower tax bracket. In that case, it may make more sense to take the tax deduction now and pay taxes at a lower rate when you withdraw in retirement. On the flip side, if you believe your tax rate could be higher in the future, then a Roth IRA could be smarter. This is especially true for younger investors who are early in their careers and expect their income, and thus tax rate, to rise over time. By paying taxes now, at a lower rate, you may save money in the long run, and enjoy tax-free income in retirement. Plus, knowing that your withdrawals won't be taxed later can provide significant peace of mind. That said, there are. If you're working on saving for retirement, ***** IRAs, short for individual retirement accounts, ***** can bring you some serious tax benefits. In this video, we're focusing on helping you decide between two of the most common IRAs, traditional and Roth. Each offers different types of tax advantages. With a taxable investment account, you're typically required to pay taxes each year on most of your investment income and on profits from any investments you sell, which can slow down your account's growth. Both Roth and traditional IRAs offer a key advantage: the investment earnings and capital gains inside these accounts aren't taxed while they remain in the account. That helps your money grow through compounding. The real difference between a Roth and a traditional IRA comes down to when you get the tax break. You're basically choosing between getting a tax deduction now or enjoying tax-free withdrawals in the future. Let's break that down. When you contribute to a traditional IRA, your contributions may be deductible on your taxes. That means you might save on taxes in the years when you're contributing. But of course, you still owe taxes eventually. With a traditional IRA, you'll pay those taxes when you begin withdrawing the money. So, choosing a traditional IRA generally means you'll get a tax break now, but owe taxes later when you take out funds. Now let's shift to Roth IRAs. In a Roth account, your contributions aren't tax deductible, meaning you don't get a break when you contribute the money. However, once the money is in the account, you'll be able to make tax-free withdrawals, as long as you've held the account for 5 years and you're at least 59.5 years old. So with a Roth, you're paying taxes now in exchange for a tax break later. So which account is better? That depends on your personal situation. The main factor to consider is whether your tax rate today is likely to be higher or lower than it will be when you retire. If you believe your tax rate is higher now than it'll be in retirement, a traditional IRA might be more beneficial. For example, by the time you retire, you may have paid off your mortgage or your kids might have moved out, meaning you need less income. That lower income could put you in a lower tax bracket, which means paying less in taxes when withdrawing from your traditional IRA. On the other hand, a Roth IRA may be a better fit if you think your tax rate could be higher in retirement.